the trade desk. This was a fun trade just because it seems like at the beginning of the trade the intention is totally fulfilled and we're definitely in the position that we want to be, but then it changes its course, and you really have to see all of the subtleties of how that change happens, and you need to react a little bit fast, to make sure that this trade is not going to become a loss for you. So this is an IPO stock that had an original accumulation range with the major sign of strength in the backing up action. Everything is kind of classical here in terms of how the Wyckoff structure develops in this range. And then we go into the climactic action on earnings, which is very similar to what we have had here on the major sign of strength. Also on earnings, we're stopping that movement, and we are going into the potential reaccumulation, a stepping stone trading range, with very well-defined phases. Stop in action in phase A, phase B, less cause. Phase B also contains one cycle of earnings, which did not have necessarily the same type of reaction to the earnings that we had in this case or in this case. So something is different, but as the price approaches the support, we're seeing all of the elements of this sprint number 3 in the potential phase C, where the price develops a second point of fear, develops the third test, and again, those are just the shortcuts that you can find in the advanced Wyckoff course. And then it just temporarily attempts to go down, does not produce the close, so that attempt fails, and comes back into the trading range on the same day. So very springy with the further test right here, and we're entering the position right here on this bar. Our anticipation is that the trend is going to continue, and the trend that I'm talking about is a very long-term trend right here relative to the history of the stock price. So we're probably looking at those type of targets to be hit up there. Also, we could take the PNF count, and I believe that the PNF actually was showing, quite a high objective. You can kind of see that there is a lot of fluctuation here in this reaccumulation range. So here is what happens, and here is the trade. As the price leaves the trading range, it commits to the upside. It kind of behaves exactly in the way how we want it. The feather is being developed, vertical absorption on the way up. We are coming to the point of the resistance, and then there is an acceleration into the climactic run, which is a short-term intermediate term buying climax, however you want to name it. And then we have a shortening of the thrust on the last bar, and that shortening of the thrust happens on relatively high volume signature, which suggests that as effort increases, there is some supply. So that suggests that we might have some kind of stop in action. We might have some kind of reversal or a change of character. And that's exactly what comes. Our thought here was about where that reaction could go and stop. And as it stops right on the top of the climactic action high, that actually gives us a lot of assurance that we're going to see higher prices. And we're doing this on somewhat of the localized decrease in the supply signature, which is extremely bullish. So usually at this spot, amateurs are going to, and weekends are just going to kind of try to get out of the position and take the profit, because at this point, having a slight profit for them is better than a potential loss or a break even. And it all goes into that emotional memory that I referred in the first trade. This is their potential point of exit. Now the price goes up after that, and again, I really like this pattern, reactionary pattern where we have a higher high and a higher low. To me, this higher high is being translated as a potential localized sign of strength that suggests that there is not enough selling to keep the price down in this backing up action, and indeed supply is not there. So what happens next that we have such a big move to the downside? Obviously, we're expecting earnings, and that would be one of the points for us, where a trading decision should be made. Should we be in this position before earnings? Should we be in this position on the day of earnings? Should we be in this position after the day of earnings? And obviously, we want to assess this based on the price structure, based on the supply and demand signature, and based on the analogs that we could extract from the previous price and volume behavior. And specifically here, we're looking at the pre-earnings run. What is it? It definitely has very weak characteristics, which suggest that maybe we're going to have something similar to what we had before on the pre-earnings run in the area of the reaccumulation. On the day of the earnings, we are trying to rally, we're gapping up, but yet some supply is coming in, and then that produces the causality for the reaction that we see. And it kind of reminds me of what has happened in this area. So when we were not necessarily rallying in the pre-earnings run like we've done here, that suggested more of the analog where reaction is going to take us down in a more significant way, rather than the gap to the upside. So I was only looking for the confirmation that this pattern is going to fail, preferably before earnings, not on the day of the earnings. And it just gave me that opportunity. So there were two bars, this one right here and this one, that would allow you to get out of the position before the actual earnings day, which had a gap to the downside. So I was lucky enough to be aware of what was happening with this pattern right here, and to find that confirmation before the earnings came. So it was a profitable position, was not necessarily as profitable as I wished it would be, but considering that the earnings produced this gap to the downside, I obviously was really happy with how this trade was executed. And in my talks to all of you guys, I usually stress out that this type of trade is actually an okay trade. It's actually a good trade. You are doing everything by the rules. You are identifying a long-term bias. You're identifying a short-term weakness. You're identifying a specific timing of phase C being confirmed by, tactical executionable ideas of the reversal test and continuation of the short-term upswing. So everything is being done somewhat correctly here. The exit is kind of like more of the more advanced concept here, where you really have to be aware of how this type of pattern is potentially failing.